Today we're going to talk about my strategy for hacking the 4% rule. This is what I personally do. I'm not recommending that anyone do it, and it's really just for education and entertainment. So what is the 4% rule? There was a popular study called the Trinity study that looked at 30-year time frames, rolling 30-year time frames, and looked for a safe withdrawal rate across all 30 periods. So what does that mean? They were looking for the minimum withdrawal rate that resulted in a sustainable income for 30 years. And they found that 4% was the lowest withdrawal rate that was safe across all these time periods that they looked at. So, what is the rule of 25? Well, it's the inverse of the 4% rule. If I'm withdrawing 4% of my portfolio, then what does that mean? That means I need 25 times my withdrawal rate in principal. So, for example, if I need $40,000 in income, if I need that 40K, then I need a $1 million portfolio. 40,000 times 25 is $1 million. 40,000 is 4% of $1 million. So 40,000 is probably a reasonable amount for, in some parts of the U.S. at least, for calling yourself financially independent. But $1 million is a lot of money. How do I beat this? Let's talk about how long it takes to hit your number. How long does it take, for example, to get to that $1 million or whatever your goal is? So, using some really nice round numbers just to make this example easy, if I was able to save 50% of my income and I was investing it in index funds, like the S&P 500, for example, that historically return about 7% after inflation over the long run, then it takes about 15 years to accumulate enough money, a portfolio large enough to call yourself financially independent. Networthify.com has a really nice financial calculator. So, plugging in some example numbers, if my take-home pay is $80,000, my savings is $40,000, and my expenses are $40,000. In other words, I have that 50% savings rate. And also, you can't see the numbers, but assuming that 7% return after inflation and a 4% withdrawal rate, then it's going to take 15 years to be able to be financially independent if I'm using that 4% withdrawal rate. That's a long time. So what do I need? I need a hack for the 4% rule. So my hack does two things, actually. First, it boosts returns while I'm still working. And even more importantly, it increases my withdrawal rate at retirement or financial independence, which is the phrase I prefer because that's my goal. So what's my strategy? What is my hack that I keep talking about? Well, my normal contributions that I'm, the money I'm depositing into my brokerage account from my day job, the savings from my day job, I'm investing that money in index funds. My hack is that I sell naked put options. So what is a naked put option? Let's get into that. How does this hack work? So a put option sells someone the right to sell me a stock within a certain time frame at a certain price. So I've heard it called a contingent liability as well. So it's naked because I don't have cash to buy the stock. I have access to margin debt from my broker. The really cool thing with this is that I'm not actually accruing margin interest unless the put option gets executed. So there's no expense to me other than the commissions for selling the put option. And finally, if the put option does get assigned to me, then I'm using Interactive Brokers. I have access to cheap margin debt, which is currently around 4%, which is a big part of why I'm willing to do this whole thing. If the margin interest rate was higher than 4%, I would get really wary of doing this. So what kinds of naked put options do I sell? Or in other words, what do I look for in that put option that I'm selling? Well, I target put options on what I call high quality stocks that are not usually not cyclical, generally have recession resistant earnings, etc. So I target these high quality stocks at prices that I want to own them at. So that worst case scenario, one of my put options executes, the stock gets assigned to me, I suddenly own 100 shares in some company. I want to be happy about that. I don't want to have any kind of remorse about that. I don't want to regret. I'm pretty conservative in my investing. So worst case, I've just purchased the stock at a price that I'm happy to purchase it at, and I can fund my. If I choose to, then I can ultimately, just make up the difference through the capital that I'm putting into my portfolio in the future. However, I target these stocks that have dividend yields that roughly cover the margin interest in case, I do actually end up wanting to sell that stock that was assigned to me at a future date. So in the case where a put option does execute, if I don't want to keep that stock, hopefully, as I mentioned above, the dividend from it is mostly covering the margin interest or even covering it and then starting to pay down the margin. But on top of that, I can sell call options against the stock that has been assigned to me to further reduce my margin debt or increase income if I so choose. So what call options are is really a conversation for another day, another video. So here's one example, a real world example of a naked put option that I sold. So May 29th, 2018, I sold a J&J Johnson & Johnson put option for $221. So that was $221 paid to me. The put option expires in January 2019. So it was very far out of the money, as the phrase goes. What that means is that on May 29th, I forget the exact value that Johnson & Johnson was trading at, but I want to say it was about $118 a share. And my put option is only in the money if Johnson & Johnson falls below $105 a share. So that's a pretty good, a pretty wide gap between the prices trading at and what the put option becomes in the money at. So as long as Johnson & Johnson trades above $105 per share between May 2018 and January 2019, that option can't be executed. If Johnson & Johnson dips below $105 per share before January, the option buyer, the option owner, has the right to sell me 100 shares of Johnson & Johnson for $105 per share. So if Johnson & Johnson falls to $100 per share, they can sell me 100 shares of Johnson & Johnson for $105 per share. One put option is always for 100 shares of whatever stock. It's just the way that they're made. So further digging into this example, I have that January 2019 J&J put that I sold. So going back to my $40,000 portfolio example, so that would be, let's say, $40,000 that I had put in from extra money I earned at my day job, that 50% savings rate that I have the potential of taking on margin debt of $10,500 from the J&J put. So that only happens, once again, if Johnson & Johnson falls below $105 per share. So I have not taken on the margin yet. It only happens if the put executes, and it's my goal that that put will not execute. But if it does, I'm okay with it because that's, in my opinion, a good price to purchase Johnson & Johnson at. So anyway, this 40K to about 10K is pretty close to a 4-to-1 ratio of equity to margin, equity to debt, so to speak. And for me personally, that's something I'm comfortable with. So I'm generating that extra $221 in cash flow from the put sale. So that's like an extra 0.5% in portfolio return if the put is not executed. I mentioned before that these index funds that I invest in have typically returned about 7% over the long run after inflation. So now with this extra $221, I'm suddenly at 7.5% in return after inflation. Furthermore, if I was going to pull money out of that $40,000 portfolio that I had, this example, it sounds like I'm still in the accumulation phase, so I probably wouldn't, but just to illustrate things, if I did want to put in place that 4% safe withdrawal rate on that $40,000 portfolio, if I wanted to start withdrawing from it today, then according to the Trinity study, according to the safe withdrawal rate, I would be able to pull out $1,600 per year, adjusted for inflation, from that $40,000 portfolio, and I shouldn't run out of money if things play out the same way as they did in the Trinity study. However, if that put option expires out of the money, then I've boosted my potential to a little over $1,800. So that's a pretty significant increase in the income that you can distribute from this portfolio. So that's exciting. It's great to be able to increase your returns after inflation. However, this is a very risky strategy. Really, it's the psychology aspect of it that's I consider to be most risky for myself. But anyway, so how I combat that is I set rules for myself, such as no more than $1 in margin exposure for every $4 in equities, in equity that I put into my account. So the example previously is pretty close to that: $40K in equity, $10,500 in potential margin exposure. I also sell way out of the money puts, so they're really not that likely to actually execute. The farther out of the money a put option is, that implies that it's less likely to execute. Once again, one of the rules that I set for myself is I only sell puts that would make me happy even if they execute. A great stock at a great price. I want to sleep well at night. I don't want to be trading and causing myself anxiety. I want to be trading and making money, sleeping well, and not worrying. So I also only sell puts on quality stocks with dividend yields that can cover most or all, or even more than all, of the margin interest. I find that helps me sleep well as also. And most importantly, in many ways, is that if I think a stock cannot go lower, I need to remember it absolutely can. So Warren Buffett has a quote where he says the number one rule with investing is never lose money. And I find that people often think they're smarter than they actually are. I'm sure I'm guilty of that myself. And a stock sometimes seems like it's hit a floor, but you just never know how low it might possibly go. Fear and greed are always there when you're speculating, when you're trading. I view my naked put options as more on the trading aspect of things than on the investing side. My index funds are definitely an investment. I plan to never sell, except maybe when I'm financially independent as part of my withdrawal. But these naked put options are definitely more on the speculation side and or the trading side. And I got to be careful not to get greedy and not to get fearful. Another important thing to consider is that if a put option executes, it can be a highly concentrated position for a small portfolio. What does that mean? Well, going back to that 40K and 10K example, if you have $10,000 worth of Johnson & Johnson in a portfolio and $40,000 in index funds, that means about 20% of your portfolio is in one stock. And that's getting a little bit concentrated. So, a different example, you could have even more concentration. So that's definitely something to be wary of. And probably the biggest risk of all is that if I take on too much margin debt, my broker can sell some of my stocks or options to reduce my margin. And that's a margin call. It's the dreaded margin call. This is a key way where unrealized losses become realized losses, and you can never make them back. So your broker, if you take on too much margin, you may violate some of the rules at your broker about how much margin debt you can have, and they'll just start selling your equity positions or your any positions that you have in bonds or stocks or whatever you hold in your portfolio. They have the ability and the right to start selling positions in order to pay off the margin debt to get you back in line with their rules, and that is just not a good situation to be in. So let's go back to the example, and we talked about how much we might be increasing our returns. So let's say if I, in my example before, I was generating an extra 0.5%. Let's say I can generate an extra 1% annually, just because it's a nice round number. This can reduce my portfolio needs to 20 times expenses. I mentioned the rule of 25 before. That's with a 4% safe withdrawal rate. If I can get up to a 5% safe withdrawal rate, then I'm basically at a rule of 20. Whatever I need, say 40,000, If I need a $40,000 income when I'm financially independent, then I take that number, multiply it by 20 if I'm using a 5% safe withdrawal rate, and it shows me that I only need $800,000 in my portfolio instead of $1 million. So I just shaved $200,000 off of my capital needs. That's huge. That's going to take me a lot less time to build a portfolio to $800,000 than to $1 million. Furthermore, so I've got that 5% safe withdrawal rate, reducing my total portfolio needs. I also reach that $800,000 faster because my returns after inflation are 1% above market returns if my hack plays out well. So to reiterate, if I'm generating extra income during my accumulation phase, as I'm still investing money in index funds, as I'm still working a day job, if I'm also generating some income through selling naked put options that expire, then I'm going to get to that $800,000 even faster. Once again, looking at Networthify, expanding it out so you can see some of the numbers. So in my hypothetical where I've got an extra 1% return above markets, I'm still using $80,000 of income. I'm saving $40,000. My expenses are $40,000. The difference between this graph and the one I showed you before is that now my return on investment is 8% instead of 7% after inflation. My withdrawal rate is 5% instead of 4% because I've implemented my hack and it's going well. Then you can see now that I've only got 12.4 years before I'm financially independent. So you more or less get 2 years of your life back, 2.5 years less that you're in a cubicle. And to me, that's a big win and really offers a lot of hope. So I'm going to continue this experiment. I've implemented it personally, and I'm continuing on with it. Things are going well, and I'll make some more videos and maybe keep you updated. Thanks for your time.